Hello, this is Brian Resney, President of Resney Wealth Management, bringing in an update about the investment market so you can understand what we see on the global landscape. You know, the second quarter is officially over for 2016. Ended up on a very nice positive note, generally speaking. Of course, we had some volatility the first half of the year. I look forward to a better second half of the year because earnings for the S&P and other sectors should start to get actually better. We look at comparisons from a quarter a year ago, and based upon oil prices coming back a little bit from the really low point of about $27, $28 a gallon roughly 6 months ago, back into roughly the $50 mark, earnings for oil companies should be a little bit better. I think that's going to help overall the S&P 500. But generally speaking, I think we're seeing some GDP growth. In fact, some of the numbers by the ISM manufacturing data suggest that we could see for the second half of 2016 GDP growth somewhere north of 3%. So we're hoping we're in that range. I think by the end of the year, we'll probably average out somewhere to 2+% GDP growth. Not great, but not bad. Again, no recession signal. And I've talked about this for months, if not years, as mainstream media and a lot of the Wall Street firms have talked about recessions and all this kind of stuff. We look at hardcore data. We're not seeing a slowdown in the U.S. We're mainly invested in the U.S. and we're going to continue to be mainly invested in the U.S., at least for the foreseeable future. Again, as I talked about a week ago in my last update, we're going to avoid Europe right now because I think there's going to be other countries eventually will leave Europe. I think Europe's going to be a very slow growth place, but eventually, once Britain leaves, I think Germany potentially a couple years down the road and a few other countries that are more fiscally sound and really have a growth potential, those could be opportunities. But buying Europe as a whole at this point, absolutely not. And I think what you're going to probably find in months to come, again, more volatility over there than really we're going to see here, but I see positive growth ahead. You know, we're seeing basically a 5-year low or close to a 5-year low in the 10-year Treasury down around 1.4%. What does this tell us? It means that some people are nervous about the exit of Britain from the EU, and potentially people are piling into treasuries. Now, again, I want to go back to something that I talked about a few weeks ago, which is, think about this. The 10-year government treasury. So you buy a 10-year bond, currently paying about 1.4%. That's how much you're going to make each year if you bought a 10-year bond. Just by buying something like the diverse index of the S&P 500, their current dividends are around 1.8%, clearly better than 1.4, with an opportunity, maybe you get some growth over the next 10 years. So again, clearly bonds are not the place to have a lot of money, but I continue to receive calls from my TV and radio show listeners about bonds. There's two kinds of investors. There's emotional investors, which is never works out well. And then there's investors who realize short-term volatility is a natural part of the investment process. I would say most of our clients are on the more intelligent side, meaning they're not emotional. They can accept some of that short-term volatility. While nobody likes it, our clients stay the course, and that has rewarded them nicely year to date. If you're a client of our firm and you have any questions, please call me and ask. If you're not a client, it's time you became a client. And of course, clients, refer your friends and family to us. We always like new business, and we like to always deal with nice clients like yourself and hopefully grow their portfolio for their financial future. Have a safe and profitable day.